Now, a lot of people doubt my 87% win rate, so I wanted to make this free breakdown for you guys, detailing my strategy, entries, exits, risk management, and my psychology, showing you guys that TRLS is not only something that I use every single day on the markets, but also something that you guys can use immediately after watching this video to change your trading for the better. Now, this video is completely packed with value, so I'm not going to waste time with some flashy intro. If you are truly interested in changing your trading and becoming profitable, take notes, watch this video to the end, and without wasting more time, let's jump into the video. So obviously, before we're able to take any trades, we need to do a market analysis. We need to understand where price is likely to go, and we also need to be understanding where our specific levels are that we are looking to take positions. So you might be asking, how the hell did I do that? Well, we use something which is called top-down analysis, and essentially it's as simple as it sounds. We are going from the weekly time frame all the way down to the 5-minute and potentially the 1-minute in order to take our trades. So starting off from the top and working our way downwards, what can you see right here? Well, essentially, what I'm looking at right now is overall direction. And for me right now, it looks as if the higher time frame is stuck in a range between these two levels. As you can see, the previous weekly closed bearish without a top wick. The current candle now has come above this range and grabbed liquidity. So for me, this is a very good indication that we have some room in the next week coming to continue down towards the bottom of this range, towards 3,200. So that has given me a bearish bias for the daily time frame and the weekly time frame right now. As you can see, the daily looks the exact same. You've swept above this range and you should be looking to come down to at least 32.85, if not even further towards the 3200s on the way back down. So after I understand my higher time frame macro bias, the only thing I need to do then is drop down to the 4-hour to look for some levels. You can see quite clearly the next 4-hour resistance area is all the way down here. So I'm actually good to look off the 4-hour because I know that we aren't really in any major trouble. As well as that, you have actually closed below a resistance right here, which essentially means you're closing into another range, which for me means we're again confirming that bias, moving down towards that 3280 level. Now we're dropping to the 1-hour now, and here's where it really gets interesting. This is where we're going to be looking to do our actual technical analysis right here. We're looking to find levels of rejection where price might react and where we should be avoiding taking trades, and also where we can look to take advantage of certain moves. So if we're looking at the chart right now, you can quite clearly see we have some rejection areas at this level right here, over and over on the charts. So to me, that seems like a very decent area to place one of my rejection areas right here. As you can see, we're respecting it here, rejecting, rejecting, respecting, and rejecting as well. So these are very, very clean levels. And this level is essentially extremely valid due to all those retests in the past. Now, once we have that, we need to understand where our support level is. So for me right now, I can see a clear level right here at 3,300. The reason being the exact same thing. We have some rejection areas here, rejection areas, rejection areas, and rejection areas. So it looks to me as if this 3303 level is being respected over and over. And actually, to confirm that as a level or not, we need to see what happens every time you close below the level. So as you can see, every time you close below the level, you do make a consistent push down till at least this area here, 3287. As you can see in the past, the same thing happens every single time you close below and push down. So for me, I know right now that we are extremely valid to be taking sells once we come below this level. And actually, the target area for those sells, if we do get them, is going to be the next support level, which for me is quite clearly down towards 3287. So first of all, you can see that I'm looking at rejection areas to validate my levels, and I'm also looking at what happens after we close outside one level, and actually whether or not that next range is filled down. And if in every scenario it is, that is a perfect level for me to place my next area, and then hence to place my TP as well. Now, obviously, if we do come back above, I would be looking for buys here. And every time you close back above this level, I can see pretty clearly now that we are doing the same thing up towards this level right here at 33.41. But as I've discussed previously, I am bearish on the overall macro. So I actually would be looking more for the sells here, maybe after a retest of this level, maybe after a closure below, but we'll get into that in a bit more detail in a little bit. But essentially, this is how I set up my area. So what I have right now is a zone. In between these two areas, this is the range that we are currently in. And in the middle of this zone right here, I'm not going to be able to take any trades because you don't want to be taking a position in the middle of the range. what I can do, and I'll show you how to do that later on, is I can take positions from the top of this range to continue down. And if the setup prints correctly, I can also take a position from the bottom of this range to continue back up. Obviously, depending on a lot more things in price. But here is where the next confluence comes into play, and that confluence is simply called price action mirrors. Now, price action mirrors essentially means how has price reacted in the past when tapping into specific levels, and essentially identifying patterns where price has made specific moves over and over, and if it has, it's extremely likely to make the same moves again. Now, the way that I identify these mirrors is very simple. You can draw them out on the chart, but again, all we want to see is what happens once these levels are being retested. So as you can see, last time we came down and closed back below this level here, we actually had a very, very strong push back up to the upside before continuing down. The same thing happened here, and the same thing happened here as well. You had a push to the upside before continuing down. So if we break this down, all we can see is, first of all, you get the closure below the level, then you tap into the bottom of the range down here towards this area at 33.03. Then you have that retracement phase upwards, and then you have an expansion back to the downside following the trend as we go. Now, the same thing happened coming over to the right here. Again, essentially the exact same thing. We have that expansion down, tapping into the level. You can see that correction back up towards 33.24 before then making a move all the way back down with the trend as we saw before, all the way down to the 32.50s. Now, if we go over back to where price currently is here, you can see that we're essentially in phase one of this move. So you essentially have phase one right now, which is the closure below. I would expect to see a tap into the level here, followed by a movement back upwards, up above this level, grabbing liquidity, and then that final expansion back to the downside. So come Monday's open, all I'll be looking for right now is the same thing to play out. I can either take buys from the bottom of this range to come back up and grab liquidity, but to be honest, I'm not the biggest fan of trading against the trend. So what I would much rather do is wait for that tap, then wait for it to retrace and grab liquidity up above 33.24, and then simply continue all the way back down, taking these sells once we get a confirmed closure, and I'll show you how that looks right now. So the first entry model that I want to teach you within this live course is essentially what is known as the fake out. Now, this is what enables me to take exactly that move right there, where we see the liquidity coming back up, followed by that movement downwards, enabling us to follow the trend. So something like this would be printing on price, where we now see this closure above the level. Bearing in mind, we've got our price action mirror to the left, which enables me to understand that this is most likely a liquidity grab to continue back down. Now, all I want to see is that closure back above this level here, which we currently have, then a closure back below the level. If this candle is engulfing, it's 10 times better. But let's say even if it's not, all you need is a liquidity grab above the level, a closure back into this level, and once you close back into this level here, you've now confirmed that realistically this range as a minimum should get filled down towards 33.03 here. Even further could be tapped, and obviously once we're getting into this range fill tap here, we're going to be risk-free. But then all I need to see after this closure is confirmed is a top wick again, retesting this level if possible, and then we're either in off the wick or in on a flip of the candle like this to take this trade all the way back down towards the bottom of this next range. And essentially all you're doing right there is, first of all, taking advantage of a closure back into your range, because as we know, once one range is closed outside of, the law states that we should continue to fill that range as we close back into it. So if you close into this range, you should be filling up towards the top of the next range. And if you close into this range, you should be filling back down, and the same here and the same here. So that is essentially the theory of range fills. But essentially with this position right here, with the fake out, all you're going to need to see is a stop above this high right here. Your take profit is going to be all the way down towards this range, even further if you want to follow the price action mirror. And now you're taking essentially a very, very high win rate entry, understanding your advantage points. Most likely, because we have a resistance area right here, you're going to be taking your break-even point right at this resistance. So the moment we tap here, you go break-even. And then you're probably taking partials at the bottom of the range, if not your full TP. Because remember, we're not trying to take advantage of the entire move. No one ever wants to catch the entire move, right? If you're trying to do that, then something's wrong with your trading, because either you're being too greedy or you're being a perfectionist. You're not trying to catch the entire move. All we want to do is take a little bit of a piece of a pie, right? You can see we have a fake out right here. All you had to do is have your stops above here. Even if you took profit right here, right, you still got some profit. Even if you took profit here, you got 2-to-1, lovely stuff. We're just trying to take a piece of the pie. So that is entry model number one. But let's say that doesn't form. What if we start to range here within this market and we actually don't get that closure above and we want to take a trade even though the market is ranging? Well, to explain this better, let me go over and actually go back to when we were ranging right here. You can quite clearly see now that we are stuck in a ranging market between these two areas in the past. So what can you do in a ranging market to take a position when we're not trending? Well, the very simple thing is, all you have to do is wait for a market to be trending, wait for a tap into the top of the level. Let's imagine that our top of the level is up here. In fact, I think it actually is, yep. Wait for a tap into the top of the level, and then essentially understanding liquidity, we can see right here, you have broken all of the previous highs and swept them and then reacted off the level. So as you come back and break these highs, this is now a liquidity grab. So essentially, you are trading, like I said earlier, not from within the middle of the range, but you're trading within one side or the other. And that is going to enable you to actually take advantage of the range from trading in one side or the other and not get caught in choppiness like this in the middle. So all we have to do is wait for a liquidity grab outside of either the top or the bottom of the range, very simply. And then as you can see, once that candle then closes respecting the range, now we've understood, okay, this is most likely a liquidity grab to continue to range, because the thing about markets is when you are trending, you continue to trend. When you are ranging, you continue to range until that one time that you don't. But the most important thing is, statistically, if you are in a ranging market, you should be trading as if that ranging market is going to continue forever. And if you're in a trending market, you should be trading the same, because if 9 times out of 10 the trend continues, why would you be trying to take a reversal just to get that 10% of the times when it actually doesn't? So as you can see here, we're ranging. We look to take the sells after a liquidity grab, and you can see quite clearly stops above these highs after the close. We got a retest into the level, so if you were lucky, you could take the retest. But let's say that we weren't and we actually ended up wanting to take the candle flip. Same thing applies, and you ride it down towards the bottom of the range. Extremely easy, extremely beneficial, because now you're trading in a ranging market, and as well as that, you can take advantage of trending markets as well. Now, let's say that we don't manage to get the pullback. Now, let's say we want to actually take advantage of the market when we are breaking out and when we are trending, and we don't manage to take advantage of the pullback. Well, how can we actually take a position based off of that? Well, this is very simple as well, and this is my most simple bread and butter entry model that essentially has allowed me to take a serious amount of profit from the market by just using one simple concept. And that concept is a breakout followed by a range fill. Now, the way this works is simple. Let's say the market is trending right now, and as you can see, we are a bit overextended here, but let's say we're a little bit less overextended, and you have the bottom of your range down here towards 33.09. Let's say the next target is 32.84, just for example's sake. You remember I said about trading with the daily structure and the daily bias? The same thing applies with lower time frame market structure. You want to be trading with the market structure. So as you can see right now, we are making consistent lower lows and lower highs. Now, we're a bit overextended here, but let's imagine we're not. All you want to be doing is taking advantage of that trend and trading with it. And essentially, all I'm going to want to see in order to get my breakout entry is a closure below this level, making sure this candle has a top wick and a bottom wick. Now, you might be asking yourself, why do you need a top wick and a bottom wick? Well, the simple answer, and I've explained this in previous videos, so I'm not going to go into too much detail, but the simple answer is because when you have a wick, this is a range on the lower time frame. So if this looks like this on the 30-minute, on the 5-minute, you're most likely going to have a range in between these 2 points. Now, essentially allowing this candle to have 2 wicks, let's say that we close below, what is going to happen now is all I'm going to need to see is a liquidity grab, essentially like a break and retest, a liquidity grab up towards that level. If you do tap into that level, I'm going to be in off the rip, and that is called my wick entry. So I'm taking an entry essentially based off of the fact that now we have made a top wick, assuming this candle has made no bottom wick on the open, and it's an anticipatory entry, allowing ourselves to anticipate the fact that this candle is then going to come down and flip and fill the range. And then your entry would look something like this, with your stops above that previous high, TP towards the bottom of the range, just as I showed you before. But yeah, very clean and very simple. Now, if you don't get the wick entry, that's also completely fine. All you have to do in that case is actually just wait for the wick to be made, place a sell stop on the flip of that candle right there, and the same thing applies. You just get a little bit worse of an entry, but your stops are still above that previous high. If you want to be super aggressive, you can place them above this current high, but I think the previous high is better personally, just especially with gold, the way it's been behaving recently. With other pairs, you could test it out, but same thing, TP at the bottom of the range and stop loss above the high. Now, before I move on to the final technical analysis standpoint, I want to actually quickly explain to you one important thing, and that is liquidity. So essentially, the market requires liquidity in order to be able to move. It essentially requires liquidity to actually be the fuel. Imagine taking your car, you got a brand new Ferrari, you take it to the gas station. If you don't fuel up that car, it can't go anywhere. No matter how powerful the engine is, it cannot move. The same thing applies with the market. If you haven't stopped off at the gas station to grab yourself some liquidity, that market is unable to move. So the same thing needs to be applied when you're taking positions. If you're looking for shorts, we need to make sure that the market has come and taken some buy-side liquidity. As you can see in this example, we wick above the highs here of the previous candle. We also wick above the range, which are two of my liquidity grabbing confluences right there. And the moment we do that, we understand shorts are extremely valid. But if you try and take shorts when there's no liquidity being grabbed, the only thing that ends up happening is you actually end up getting completely wrecked. As you can see in this example, what happened right here? We've started to push down the entire way. This candle grabs no liquidity, this candle grabs no liquidity, and if you tried to take shorts on the breakout of a closure below this candle, the only thing that would have happened is you got wrecked and you actually held a load of drawdown, and that is because liquidity was needed. And in fact, we actually grabbed liquidity from below, which should have been an indication that in fact we are actually going to push back up in order to grab more liquidity to come back down eventually. So to understand this fully, you need to make sure that you're grabbing liquidity from the opposite side of whichever direction you're trading in. If you're looking for buys, you need to make sure the market has come below to the sell side and grab liquidity from there. And if you're looking for sells, you need to make sure that the market has swept above to grab liquidity in the form of a wick from above in order to actually push us back down. Now that is how I take my trades, but how do I actually manage them? Well, the very simple factor is the only way you can be managing trades is by having your setup formed before and understanding where your advantage points are and where your stop loss and where your take profit is. So understanding this essentially is going to enable you to actually have confidence in the market. Now I mentioned the word advantage point, and what does that even mean? Well, an advantage point is essentially an area where the market should tap into before making any decision on other direction. Now, how do we understand that? Well, sometimes it can be essentially a support or resistance area just like this. You can see that in the past, the market has needed to come and tap into this level over and over before making a decision. This case, it decided to decide upwards. This case, it decided to go downwards. This case, the same, downwards. But each time, it was coming and tapping into the same area before it actually decided to make that decision. Now, the same thing could apply here. So that could be your break-even area right there. Or alternatively, you could actually look at where liquidity was grabbed from in the past. So let's say we got in these sells right here. You could identify the fact that we've grabbed liquidity from the exact same areas in the past over here. The minimum being down here towards 33.35. So if we were in the wrong direction and we accidentally got in a sell when this was actually just a liquidity grab, we can now identify, okay, we should tap into 33.32, but after that, nothing is guaranteed. So once you do tap into that area, what you can do is go ahead and move your stop loss to break even. So that advantage point for me is always going to be my break even area. And after that, if you do want to secure profit or sort of manage to trade on the lower time frames, all you have to do is essentially stick to the market structure and wait for highs being made, and then you can look to trail your stops. So if we have break-even stops after we've used our advantage point, then what we can actually do is begin to trail. So we can have our stops above this high. Once you make a new low after making the high, again, just following market structure, you expect us to come down and make a low, make a lower high, make a low, make a lower high, etc. when we're coming down. So the same thing happens with our stops. We can actually trail our stops above this high. Once you make this low and wait for it to make another high, you trail your stops here. And once it does the same thing again, you trail your stops, and eventually you would have got taken out sort of around this area towards the bottom of the range. And that's how I manage positions. And alternatively, when we're in drawdown, the same thing applies. So we want to be looking to see if the market structure is still with us. And if it's not still with us, then what do we want to do? We want to get out of the position. So let's use buys up here as an example. Let's say you got in buys above a breakout here. Well, essentially, imagine your stop loss was down here, super big stop loss for this example's sake. But what actually starts to happen here is, yes, you make some highs, but you actually come down now and you start making some bearish market structure. You're making lower lows and lower highs. Now, the moment you start to make lower lows and lower highs, you should be closing out the trade. Combined with the fact that actually now we closed below the previous level here, for me, this is a number one identification. Okay, I'm actually going to be exiting the trade here. And we're going to get into the psychology in a little bit, but essentially being able to close trades in a loss is the number one skill that leads to profitable traders, because essentially you're detaching your ego from the position and you're allowing the money and the actual market to tell you exactly what to do when you're in the position. Now, using this management strategy has enabled me to get a super high win rate and also allow big trades to run. For example, yesterday I took a position which ran for $2,000 purely by trailing my stops and not exiting too early. Same thing applies with losses. Essentially, having such a high win rate is because I understand the advantage point of the market and I actually understand where price is likely to tap, but then I'm protecting my capital by moving my stop loss to break even after the market taps into the levels where essentially the minimum rejection area should be. So that is your advantage point, and that allows me to actually secure my trade and stop any downside from being taken because I understand where the market should go, and also the fact that I might be wrong, detaching my ego from the situation and saying, okay, this has tapped its minimum point, but now it could reverse on me and could be at a decision area and I'm likely to actually be in danger. Let me go and secure some profit, or at least protect my downside in this position. You would have noticed that throughout this, when I'm calculating my take profit and my stop loss, I have not mentioned risk to reward once. And the reason being, this is what has enabled me to actually beat the market and get such a high win rate. I'm determining my stop loss based off of where the market is telling me. If I wanted to have my stop loss above these highs, that is going to be the most valid stop loss for me to have. And I understand that if the stops get hit, most likely I'm going to be risking way more capital because the market is likely to continue in the opposite direction. Now, the same applies with take profit and risk to reward. If I wanted to have a fixed 2-to-1 risk to reward down here, essentially what would end up happening is you might reject off of the level and essentially come back up and hit your stops, which has happened to a few of my students in the past before I taught them this lesson, because you're targeting a 2-to-1 with no specific reason other than the fact that your ego tells you you need to post on Instagram that you had a 2-to-1 risk to reward. When in reality, you should be letting where the market has rejected in the past dictate your stops, because that is what is going to happen again. The market does not care about how much money you have on the line, does not care about your Instagram screenshots, and it definitely does not care about where your risk to reward is on the trade. So that is everything I want to teach you on the technical side. We're going to quickly jump over to my risk management philosophy right here to end off the session, because I want to talk to you about something here. Now, you can have the best strategy in the world, but if you are not managing risk appropriately, there is absolutely a 0% chance you become profitable. Because what is going to happen is, if you face a losing streak, which I have faced, which any profitable trader has faced, if you're risking 10, 15% of your account, if you lose 5 to 10 trades in a row, that account is gone. No matter how good the strategy is, no matter how good your setups are, if you face a losing streak, which any single profitable trader will face, your account is gone. So you need to make sure that you're risking the appropriate amount. First of all, you're not risking too little to the point where you're actually not making any profit, but also to the point where now a losing streak is not going to wipe out your account, because that is the number one problem traders face. So my general rule is, if you're trading a prop firm, you need to be risking 1% max, because you have 5% trailing drawdown, sometimes even less for the day. So you need to be understanding, okay, I need to give myself the ability to lose 5 trades and be completely okay with it. You know, so you can survive by losing 5 trades if you're risking 1%. Now, if you're risking 2, 4, 5%, you know, you might get to the point where actually you could have passed the account, but your risk was a little bit too high and you blew it too early. Now, if you're trading a brokerage account, it's a little bit different because you don't have these rules. And for me personally, depending on the size of your account, if you are a little bit newer, you can afford to risk a little bit more. I would say between 1 to 5% is probably the maximum for you. If you wanted to, if you have a really small account, you could maybe push to 10%. But realistically, you should be trading even a small account as if it was a big live account, because essentially a lot of traders are going to say, okay, you know what, I have $100. I'm going to over leverage until I have a large account, and then I'm going to trade, you know, appropriately. What's going to happen is they don't stop and they continue over leveraging because it might have worked for them. And even if they get to a larger account, which most of the time they won't because they've blown it, what is going to happen is they end up blowing it anyway. There's no point saying you're going to trade properly once you get to that large account. That's like Cristiano Ronaldo saying, I'm going to train to play football, or I'm going to play football properly once I become a professional footballer. If he would have said that, he would have been in trouble, right? But he actually did it properly from the start, trained properly, and actually played properly in all his games. The same thing needs to apply with traders. Now, even if you're risking 1% to 5% on $100, what's going to happen is that compound effect is going to quickly take advantage, and you're actually going to end up growing that account extremely fast anyway, whilst removing any chance of you sort of blowing that account. So realistically, that is the main thing right there. Risk between 1 to 5%. Now, what you can be doing as well is you can be obviously compounding it as you go. I would definitely advise that. So every month or so, reevaluate where your risk is, and maybe, you know, up it if your account's grown. If your account's dropped, keep it the same. I wouldn't really want you to drop it too much unless you're sort of at the point where you're blowing your account. But essentially, that is my approach to risk management. Now, psychology-wise, there's one thing I want you to leave this video taking away, and that is each trade is an individual event, okay? You should never, ever, ever be thinking about account size or your potential profit. So a lot of people go, you know, oh, I can make 1K on this trade, I can make 500 bucks. If you're thinking that before you get into a trade, take a step away. The only things you should ever be thinking of before you enter a trade is, where is my SL, where is my TP, and where is my break-even point? And before that, you should be thinking, is this a valid setup? Has every single confluence aligned? If it has, then you're taking your setup. If not, you stay away. And that is literally it. The money will come, okay? Money comes naturally when you follow your process. So focus on the process first. Focus on actually trading the valid setup, risking the right amount, and not focusing on the money, but focusing on the technicals behind your trade. And that is going to get you much further than someone who is thinking about the money only. It goes back to that famous saying of the person who likes walking will walk much further than the person who likes the destination. If you fall in love with trading, fall in love with the process, you are going to go much farther than someone who actually just wants to make money. So there you have it. This was my complete TRLS system, essentially a free course on how I trade the markets every single day, how I take advantage of price action, and how I let the market dictate my trading rather than trying to dictate to the market how I can trade. So essentially, using this approach is what has enabled me to become a full-time trader, to quit my 9-to-5, and all of that sort of thing. Now, if you are interested in learning why this strategy works even more, learning the reasons behind what I do and how the numbers actually work behind this strategy, I have recorded a free training, which I'm going to leave it down in the description below, completely for free. So go and click that if you want to find out more. Otherwise, make sure you like the video, subscribe to the channel, and turn up to the daily free live trading streams that I'm doing every single day for New York session. Peace out, much love. I'll see you in the next one. Bye-bye.